All right. Good morning, good afternoon, and good evening, depending on where you are around the world. My name is J Kahn. This is probably my fourth or fifth time back in the FXStreet realm, and glad to be here. You have my website there where you can find some additional information about me, and then I'm also going to show you some information in the FXStreet profile and information as well as we go through these slides. There's my email if you have any questions. All right, let's move into the next slide. And we just have to get through this disclaimer very quickly, and I'll scroll down so that you can see it. But just keep in mind, there are no buy, hold, or sell recommendations. This is for educational purposes only. And I will be showing you various platforms. Again, those are not any recommendations for you to just jump out and go and put your money with those brokers. Those are just, again, for examples as well. All right, a little bit about me. Just like to do some standard operating procedures as I go through and kind of introduce myself. About me and Jupiter Peak Financial Consulting. I put up there ski bum. That's important because if I can do it as a ski bum, if I can learn to trade and invest, anyone can do it. I started out scalping, trading for very, very, very short periods of time. And then I started to adapt as the markets adapted, as technology adapted, as trading locations adapted. You didn't have to be at the market centers. I could trade various markets, various strategies, and also, most importantly, various time frames. So not just scalping, but trading for, instead of seconds, minutes, then weeks, then months, and trading different strategies, different time frames for different reasons. I founded the consulting company Jupiter Peak Financial in 2008, and that is because a lot of people started saying, my broker lost my money, my broker lost my money, my broker lost my money. And I said, absolutely not. Your broker didn't lose your money. You chose to be in the equity markets, and the equity markets took a pretty big crash. And that's why you lost money. Your broker is not there to tell you what to do. They are there to answer the phone, and you tell them what you want to do. If you need help making a trade, if you have a little bit of, you want a suggestion here or there, they can help you as far as where to put your money in different types of accounts, a little bit of, kind of broad tax advice and things like that. But if you wanted to stay invested in the markets, that was your choice. It's your money. Just remember that you have full control over it. My approach to teaching, I want people to be educated on the short-term side and the long-term side. I want people to use various markets because I use various markets. I want them to understand the broad picture of investments. I want them to understand how inflation comes into play. I think that you just had a webinar that talked a lot about inflation. I want you to understand economic policy. We've got to understand economic policy now. Review and today. All right. My trading strategies. I talked a little bit about how I started out as a scalper. I use the Forex markets as a combination scalp swing, mostly scalp, mostly short term. I kind of call it swalping. I combine those two words. I also use Forex to hedge, meaning hedging equity markets or hedging a long-term position. So I may be long the euro and think that it's going to go up and up and up, but I think that for the next few minutes it's overvalued. So I have another account where I do my short trade because I think it's overvalued, even though over here in my longer term trade, I'm bullish longer term the euro, but for the next few minutes, I want to make a short trade. And some brokers don't let you inter-hedge those Forex pairs. So you have different accounts. I also use Forex to hedge my equity market accounts because there's relationships I'm going to show you between the United States dollar and between equity market directions. I also use options, and I use options for three reasons: to grow an account, just like Forex, you try and grow your account. It's kind of an aggressive day trade type thing to grow your account. I use it for income, and income means something to me. It might not mean something to all of you. Income generally means 1% to 2% of the holding, whether that's your portfolio value or the actual value of the stock or the option. So think of income as an income strategy, just like you think of bonds as income strategy, a small amount of income that's not guaranteed but pretty safe. Well, that's what we're doing with options. We're using them to generate income off of our holdings. And then finally, portfolio protection. Right now, I'll talk about the equity markets where maybe they're a little bit overvalued. We have some chart patterns showing up. But the bottom line is options can be used as a hedge against equity portfolio, just as the same way Forex markets can be can be used as a hedge. Again, this disclaimer at the bottom, understand what each strategy is meant to do and the risks of each strategy. There are no free lunches. So can you be hedging your equity portfolio using Forex or options and the hedge loses money and your equity markets lose money? Absolutely. There are no guarantees out there. So you have to know what you're doing with the strategy, why you're doing it, developing trading plans. That's very, very important. But hopefully my education today will come out to you that it's broad-based and it covers all markets, and it kind of you need to combine all of this information to create a trading plan, whether it's for the next few minutes in Forex or whether it's for the next few weeks or months in Forex. You still have to combine information to make a trading plan. So the first question came through, and I forgot to mention that. Please, you guys, ask any questions at any time. I've got the panel up here, and I will try and monitor it, and I will get to your questions. So the first question, Brian, by scalping, do you mean looking for positions even on 1-minute charts or on higher time frames like 15-minute or 30-minute? I'll show you my time frames in just a moment, Mike. For the most part, I believe, okay, and this is my opinion, in the Forex markets, and we'll talk about what's realistic given an intraday Forex market trading range, but I believe that right now 10 to 12 pips is a reasonable goal for a scalper / swing trader, so a swalper, if you will, that I put up there. So risking 8 pips to make 10 pips, risking 10 pips to make 15 pips, something like that, depending on the day and the volatility in the trading range. And I'm using, to answer your question, I'm using probably 5-minute charts. I kind of keep a broader view of the 30-minute charts, the 15-minute charts to see a little bit bigger picture. But if I get into the trade, I'm looking for the trade sequence and for the uptrends and the downtrends on that short of a time frame for that small amount of pips, probably on a 5-minute chart. I don't think, with the trading ranges right now being where they are, I don't think you need to go smaller than a 5-minute chart. That's my opinion. I think you can handle it. Obviously, it all depends on the size of your screens. If you have very, very long, if you have multiple screens and you have each pair that you're looking at on a very long, horizontal, screen, then you might be able to go down to 1 minute because you have a lot to see. So again, a lot of it depends on how many screens you have and how many pairs you're looking at that time as well. All right. Why do I teach? It's a win-win for me. First of all, I'm social, so I enjoy working with other people and talking with other people and doing things like this. Today, I can multitask. I do have about 5 or 6 screens. I can talk with a client on the phone. I can make a trade at the same time. They understand that I'm trading first, educating second. So they want me to be trading, obviously, if I'm going to be teaching them. But also trading can get lonely. Trading can be boring because when volatility is low, and we'll talk about that, not a ton of excitement. And so the worst thing I could do is be by myself in my office and hit the button just out of boredom. So this gives me something to do. It also, keeps me sharp because people are asking me questions, just like Mike did. People are asking me to look at this market, this currency pair, this relationship. So I've learned from my traders, in my students and my clients just as much as they're learning from me. Credibility, I've been trading for now 15 years. I can update that for 15 years. And I teach. So I think that credibility, works well, that I'm actually doing it and teaching it. I'm not just sitting there and professing this. I actually do it. The accountability, maybe I'm a slow learner, but I learn by doing. Practice. That makes perfect. So the more I talk about it and hold my students accountable, the more I'm accountable to doing the right things as well. And then finally, this is relatively new. It's a big leap for a scalper trading for seconds now to managing money. I have a Series 65 registration. I understand fiduciary responsibilities between a client and between me on the education side, but also on the management side. I actually do all of the strategies that I'm talking about on long-term retirement money for people's portfolios. So I do also manage money. So I'm not just teaching. I'm actually doing this every day, every week, every month in various timeframes for various reasons, for different situations depending on that person. Outline of where we're going today. I like to provide you with a little bit of a roadmap. We're going to talk about trading psychology. Without understanding trading psychology, I think that trading can be very tough. If you look at any trader's library, 20% might be technical analysis and some area over there as far as charting and things like that. 80% of a trader's library is going to be on the mental aspect. and trading psychology, the psychology of trading, winning versus losing. It's against the human psyche to lose. So we have to be good losers, and it's hard to be a good loser sometimes. We have to be good losers and kind of move on to the next opportunity. So trading psychology, I'll give you a few slides. I'll give you a fundamental update, a technical analysis update. But again, that all is going to roll right into our quarter 3 review and quarter 4 preview. But the point is, I want you to know that you've got to combine trading psychology. You've got to combine fundamentals and technicals to make a trading plan to be a very consistent, successful trader. A little bit about your opportunity, and then we'll do the review and give you some resources. You are the system. A lot of you that have been with me in the past, you know this slide. And again, depending on if I'm compliant, this may be recorded, so you'll be able to ask FXStreet about that. But and you can go back and review these, and you can go to my profile page, which I'll show you in a second, that this slide happens over and over and over. I believe that you're the system. If you understand who you are as a trader and what's achievable for you, you have a chance to succeed. You have to fit the markets. Do not make the markets fit you. The markets, just imagine a big puzzle just spread out there and all the pieces, all right? And you have one piece in your hand. You've got to do a lot of work to fit that puzzle into, that piece that you're holding in. You just can't guess, okay? You have to do a little bit of research in the beginning to understand where does it go, what's it going to line up next to. That's the same thing. You've got to fit into the markets. Can you define your trading personality? Why did I put that question there? Because we're going to leave this slide very quickly, and I'm going to go over to my profile in FXStreet and just show you some previous information that I've given you. And before we do that, as we go into the next slide, here's fundamental analysis. So I just want you to know that FXStreet is providing you with really, really important fundamental analysis that, again, I think you need to be using to create trading plans. So I won't spend too much time on this slide because it's actually going to go right into our quarter 3 review and preview, but I want you to read this. I want you to pay attention to a couple of things. Central bank intervention, VIX, which is the volatility, realistic trading plans, and then once you've understood your personality and you have a sound understanding of these major fundamental drivers that are out there, it is off to the charts. And again, now more than ever, due to all this central bank intervention around the world, you've got to have a good handle on the fundamental drivers, all right? So we're going to go ahead and leave this screen, and I'm going to go ahead and minimize everything right here, and we're going to pop up into the profile here. Okay, so this is my profile. And this is where some archived information is. So I have a number of webinars here that are archived, and one of them titled here, Your Trading Personality, Using Your Trading Personality to Implement Trades. I think that's a very important one if you're having trouble understanding where you fit in with the markets. Also, just a preview, next week I will be involved in FXStreet's One Day, One Topic, where we're going to go through intermarket analysis using multiple markets to create trading plans. So mine is titled Using Ancillary Markets to Trade Forex. So I hope that you'll join me on October 10th, and you can see at 1400 GMT time. As far as the economic data goes, all right, this is what I'm talking about. FXStreet provides you with a great economic calendar, lots and lots of information here. You've got to be paying attention to it because it's not so much that the economic data is driving the markets. That economic data is taking a backseat to economic events such as the European Central Bank, the Bank of Japan, the Bank of England, the Federal Reserve, and Ben Bernanke talking, and QE3, which just happened a few weeks ago. That's all on this calendar, and you need to be aware of it so that you're not trading and you don't have a position, and then all of a sudden Bernanke speaks. You need to be aware of it because when he speaks, the markets listen, and the markets are moving in reaction, and so it's not a guessing game. He said this, markets should do this based on what he's saying. Okay, what are the markets doing in reaction to that? All right. And then I'll go to my website. We'll finish that on the back end. I won't go there now. So we're going to go ahead and leave this, the very quickest page, and we're going to, as you saw in that slide, jump into the markets. Because once you understand you as an individual, once you understand the fundamental analysis, then it's off to the charts. Okay? And thank you very much, Maud. Over at FXStreet, if you see in the panel there, they just actually provided that link. There's the link for the one day, one topic event on intermarket analysis. So you can find the link there if you want just over in the panel, so you can see it there. So again, we're leaving this slide now with trading personality defined and a sound understanding of major fundamental drivers. It's off to the charts. But before we go to the charts, I want to talk about the fundamentals that happened in quarter three. Okay. So technical analysis, just some basics on technical analysis. Again, I just want you to see this slide. I'm not going to go into detail because we're going to do it when we go into our review and preview. But 3 words: trend, support, and resistance. Understand those 3 things. I think that you'll be trading in decent locations. The trend's your friend. Buy at support, sell at resistance. Do not play in the middle. And now you can build trading plans with chart-based reasons for entry, technical stops, and technical targets, all using the charts. So combine trading personality, combine fundamental analysis, combine technical analysis, and you have a trading plan with predefined risk to reward. Quarter 3 review. What happened in the past quarter? Fundamentally, a lot happened. The economic data around the world is slowing. It is really, really, really poor. No matter what region of the world you have, it is poor. So intervention has been the theme. Okay. So with that, what are the equity markets doing? Because we'll get into the technicals in just a moment. So the equity markets are responding very positively to it. So as long as the Federal Reserve and the central banks around the world are saying, we're here for you, and if things continue to get worse, we're still here for you. That's what I mean by QE does not have to end. Austerity measures, liquidity, quantitative easing, accommodative policy, whatever you want to call it, they do not have to end. The central banks can continue to intervene. That is not great for us as traders, but we have to be aware of it. So technically, what's going on with this? All right. What is QE? What does a rising equity market mean for trading ranges? We'll be able to look at this through the volatility gauge. Then we'll start to go into intermarket analysis. So no matter when I'm talking or writing, I'm always talking about intermarket analysis and ancillary markets. And that's obviously what the one day, one topic will go into a little bit more detail next week. We'll look at trends. Are there any? And ranges, are they intact or breaking down? So let's go back and review what's gone on in July, August, and September, which was quarter 3. So I'm going to start out, while this comes up, we're going to start out with just a quick look at the equity markets first, okay? And again, what I want you to focus on first, this chart that I'm going to blow up, is VIX. This is a volatility gauge, and this is a long-term chart of the volatility gauge. This is when the markets were crashing in 2007, 8, and early 2009. And then the markets recovered in late 2009, all of 2010, and 2011, and so far in 2012. So in the middle of the summer, we had a hiccup in 2010, volatility increased. In the middle of the summer in 2011, we had a hiccup. Greece was like kind of exploding last summer, if you remember, and volatility increased. Greece also kind of exploded this summer, even maybe more so than last summer, but volatility did pick up, but it's much less so. So overall, you can see that volatility is going down for the most part. And it's down here right now on its lows down here. So volatility, the number of people having an opinion and going in and having conviction one way or the other is getting less and less and less. So just so you know, volatility is down. That is going to affect trading ranges. Just on the opposite side of that, just so you can see what the stock market is doing, this is what S&P is doing over the same time frame. I'll put it out on a weekly time frame. So here we are. 2009 we rallied. 2010 we had a little bit of dip and then we rallied. 2011 we rallied and went sideways, a little bit of a dip and then rallied late in the year. 2012 we started rallying, had a bit of a dip, and now we're rallying. So the equity markets, as of a few weeks ago, is basically the highest it's been in the past 4 years. So the equity markets are going to the moon in response to intervention, and volatility is going down in response to an equity market that is saying everything's great, no fear, no uncertainty, no anxiety. Now we have to find out what that means for our Forex markets. Now that you have a view of the equity markets volatility And volatility you can relate to trading ranges. What does it mean for the frequency of trading and how much am I trading? So there's your quarterly picture. If I can shrink this down for you just to see the past quarter, here's your quarterly picture. Here is August and September. I'm sorry, July, August, and September, the markets were going up. If we can look at the volatility gauge during the same time frame, July, August, and September, let me shrink this down. Okay, we have July, August, it peaked up a little bit, and then right back down to its lows in September. All right, so volatility did go down, back down towards its support level. And you can see, I talked about support. Where are they buying the VIX? Where do they think the stock market's overbought and the VIX, the fear gauge, is too low? Well, they're buying the VIX down right around 1330, 1340. Okay, that's factual data. That's not a guarantee that's going to happen in the future, but that's a factual data based on previous performance that every time it's gotten to 1353, let's say, they bought the VIX up. All right, so if you're an equity trader and you want to go long the VIX, or if you're an option trader and you want to buy calls down there, that's obviously the play. If you're looking to hedge your equity portfolio, then obviously that's your play. Does it go up a lot? No, but that's why you use trading plans. How much has it gone up in the past? And you start to build in. And if you can make 3%, 5%, 8% in an equity trade, if you can make 5%, 20%, 50% in an option trade, I think you're doing pretty well. Remember, make it realistic given what the markets are doing. So let's leave this and we'll pull up our monitor here. If earnings begin to look bad for companies, I'm reading a question. If earnings begin to look bad for companies, it seems to me that Fed easing will not make a difference to the market. Your thoughts? Len, I think that you're absolutely correct. I wrote this article, and I'll show you where I write my articles that get duplicated over to the FXStreet profile and just at the end of the webinar. QE now is in the past. Can they do more QE? Absolutely. But what I wrote just this past Sunday is if the economic data gets bad enough, whether it's consumer confidence, retail sales, jobs data, manufacturing data, if it gets bad enough, and on top of that, earnings start to get bad, now that we've just had our most recent round of QE, they might have to say things have to get a lot worse for us to do the next round of QE. So that's why I'm neutral to bullish the markets, but up here, I'm talking about the equity markets. I'm a little bit bearish here just because QE has been done. It's kind of a known event. And if the economic data does continue to underperform, including earnings, then yes, that may make the market suffer. Will the market suffer a lot? In the past, the equity markets, anytime they've sold off 3%, 5%, 8%, it's been a buying opportunity because the equity markets lend, as you know, go right back up. So keep that in mind. And I'm not saying we're in a crash. I'm saying you might get maybe a better buying opportunity if that happens than today, if data continues to get worse. Is there a correlation ratio based on VIX and the ADR of a security? Yes, that's what I want you to pay attention. I want you to pay attention on a rough scale where volatility is and where trading ranges are now. And then if volatility picks up, what does that do to trading ranges? So from here on out, I want you to pay attention to that. And that's what helps you to build realistic trading plans is here's the VIX now, here's the trading ranges right now. I'm a trader right now. This is what's achievable. In 3 months, the VIX is in the 20s and the 30s instead of in the teens, and the trading ranges are 1.5 times what they are now, or 2 times now, then you can say, I can scalp for 20 or 30 pips because the trading ranges are 150 pips in the pound in the US dollar versus being 70 pips per day where it is now. So that's what I want you to focus on is make a trading plan based on where volatility and where trading ranges are right now and always use that going forward. It is not fair for you to say I'm a scalper in Forex and I can get 50 pips because that's basically the bulk of the trading range. You'd have to have the dead low and the dead high and be perfect on that move. But to make 8 or 10 pips now, that might be achievable. Is it achievable every day? No, I don't think that there's trading opportunities every day as scalpers. When the volatility is in the 30s and the 40s, there's more likely going to be trading opportunities on a daily basis or multiple trading opportunities. So the VIX kind of influences how much you're trading for as far as pips and percentages if you're an equity or options trader and how frequently you're trading. Do you scalp on the Forex markets? You may have come in late. I think that's Boyke asking that question. Yes, my background, and you can see that in the previous webinars. You'll learn all about how I use Forex as a scalper and as a intermarket hedger, kind of a position longer-term trader. So Q3 review, I think we hammered the fundamentals. I think we hammered the technicals, but we didn't do the Forex markets there. So we know that the equity markets are trending up, VIX is trending down. Let's now go into the Forex markets and look kind of back at Q3, and then we'll jump into Q4. All right, in front of you, you should have the 6 majors. I mostly trade the majors. I'm in the Americas, so I unfortunately don't live in Europe, which I think would be a fun trading time frame, and I just choose not to be up all night trading. So I choose to trade because I live in the Americas. I live over here. I understand what's going on in this economy, and then I just have to compare it to what's going on in the pound or the euro region or the Aussie or the New Zealand or the Canadian or the Swissy. I'm not big on trading the Japanese yen versus the Aussie because I don't live in Japan. I don't live in Australia. I don't get those economies as well. So I'm trying to make it easy. I already know one economy. I feel it and see it every day, and it's covered in my news, in my time frame when I'm awake. And now I just have to compare that against one other. So let's look and see what's going on. And I'm going to hammer out a lot of what's happened as far as the past quarter goes when we go into the webinar next week. So hopefully you'll join me for that. Just on a daily time frame, let's just see what happened in the pound versus US dollar in the last quarter. Remember, equity markets went to the moon, VIX went to down. So what happened in July, August, and September? Which way did the pound go? It went to the moon. Not hard to see. All right. And again, this will carry right into next week's webinar. What did the euro do in the last quarter? July, August, September. To the moon, baby. Same exact thing. The Aussie, what did it do? July, August, September had a dip and right back up. So overall, it's kind of more sideways, but definitely strong against the US dollar. It's definitely not down against the United States dollar. The New Zealand dollar against the US dollar, kind of closer to the Aussie range, Aussie area, so probably similar. Here's July, okay? August had the same dip, and then September had a rally. Again, it's at its highest point in the last quarter. So again, the New Zealand dollar is strong to the US dollar. Here we are in another commodity currency, if you will. The Australian dollar is a commodity currency with gold. And here's the Canadian. What did they do in July? July, sideways, and then all of a sudden the United States dollar dropped. August, United States dollar dropped. September, United States dollar dropped. And then finally, when oil got overbought, and this is one of my favorite intermarket relationships using ancillary markets, I'm going to hammer you on the oil and oil price, US dollar, Canadian dollar relationship. This right here was the bottom here, was actually the bottom of the United States dollar against most currencies out there right here on September 14th. Go look at your equity price high on the 14th. Go look at oil prices high on the 14th, and you will see my preview you'll know what I'm talking about next week in that webinar for FXStreet, one day, one topic. All right. So that's what we did last quarter. Technically, we're definitely trending against the United States dollar. The United States dollar, for the most part, is definitely trending down. Here's the last one. Here is the Swissy. And here is July. Here's August. And then here's September. Okay. Definitely a downtrend in the United States dollar against the Swiss. All right. Let me just jump back now, and we can go ahead and see what Q4 holds now as I jump back into the slides here to see, are these trends going to continue? All right, I think Mike asked another question. I think trading the euro, US dollar, and the US Swissy majors can lead to taking double risks at times since they have near perfect negative correlation. So keep in mind, what I'm talking about is what did the equity markets do, all right, and combine these intermarket relationships, and what did volatility do, and what did the United States dollar do? So volatility is kind of the middle ground there. Volatility really more has to do with the trading ranges and the frequency of trading and what you think is achievable. But really, the relationship is, I understand the equity markets are going to the moon as a result of QE and all that stuff going on around the world. And let's face it, the United States isn't the only one doing QE. Everybody's doing QE, all right, in some form. But the United States dollar, just the plain relationship, it's very, very easy to see. United States dollar weak, equity markets going up. That's all you have to know. You're not trading the euro US dollar, comparing it to USD Swissy. You're comparing the euro to the US dollar and the USD to the Swiss franc. Those two. Don't compare 4 pairs. Compare 1 pair to 1 pair and then 1 pair to 1 pair. The USD against the Swissy and the USD against the euro, they're doing the exact same thing. All right. Why do I prefer scalping? Well, I've always been a scalper. I've done it. I scalped off of economic news for years and years and years and years, and I know how to do it. It's a bread and butter thing. But remember, I used to scalp for seconds. This is before black boxes and gray boxes in the late 90s and early 2000s, and when we had a lot of volatility after 2001 and 2002, and then we started to recover. So when I say I'm a scalper, sometimes I'm scalping, and in these days with low volatility, a scalp might take 8 minutes. Back when we had lots of volatility, a scalp might take 30 seconds or 10 seconds. So remember, it's changed a little bit, but I just still think that there's enough opportunity in the markets to still be a scalper. I'm not only a scalper, but when I see the opportunity, I'm going to try and scalp/swing. So I kind of, again, combine it into a swap trade. It's not a 1 second trade. It's, a couple, 30 seconds, a couple minutes, all depending on the volatility and the trading ranges. So we know there's trends and ranges, not really any ranges right there. I think it's more trending than anything. So I think that we nailed that in the quarter 3 review. Going forward, quarter 4 preview, fundamentals. I've already told you that economic data is slowing. All right. The economic calendar, if you're paying attention to FXStreet's economic calendar, which I showed you, the data this past week in the economic calendar for the U.S. has been really, really, really bad, really bad. And we have a major report coming out in just 3.5 trading days on Friday. We have the unemployment report. Keep your eye on that. If it's bad enough, and QEs in the past, are the markets going to continue to go down? So how bad does it have to get? Whether it's someone before mentioned earnings, I think that was Len, and a combination of bad economic data. Can we get more intervention? Absolutely. I said QE is never out of the picture. They're always still there. We have to be aware of that. Technicals, what do I think is going to happen going forward? Are we going to be in trading ranges? What's my trade frequency going to be? How much do I need to be going for as far as pips? So that's what I'm going to use the data going forward to update and tell me what I think is achievable with trading plans and frequency and size of my trades and size of pips that I think I can go for. So let's jump into the quarter 4 preview, and we'll do it technically and fundamentally. All right. First, though, we're going to leave the Forex markets where we were, and we're going to go right back into the equity markets and set it up there first. Okay. All right, let me pull up the S&P on a longer term time frame so that you can see it. We've been doing very, very well, as we know. We're approaching the old highs. This is before the crash in 2007 and 8. They're not far away. That's at 156. We got as high as 148. So percentage-wise, that's only about 8 or 10 points away. That's, less than 1% away. So if we go from 148 up to 158, 10 points, about, that's not far at all. So I'm sorry, that's $10. So yeah, so it's about 8%, 8 to 10% move higher, and we're going to be at new highs. No matter what's going on out there with the equity markets, as far as economic data and data over in Europe and unemployment, if we go another 8 to 10% higher, we're basically at new highs in the S&P 500. Pretty impressive. All right. The trend is definitely up. Right now, we have a lot coming out fundamentally this week in the U.S. calendar. We have a lot coming out next month with elections and things like that. Maybe the markets are just saying we're going to take a pause for a little bit. And if we get our answer, whether it's Romney or Obama, we just have certainty for the next 4 years and we can go ahead and maybe they continue higher. So until fundamentals change and technicals change, I'm still going with the trend and I'm neutral to bullish. But for the next few weeks, I'm kind of a little bit more neutral than bullish. So if I bring you back down to a daily and we just look right here, if I wanted to draw a trend line right on here, you know, we have a little bit of a topping action, something like that. All right. And then we definitely have a trend line right with the bottoms. And actually this trend line goes kind of like that. So there's a longer term one kind of like that. So we're squeezing in. Maybe you could say this is an ascending triangle, something like that, and we're going to pop to the upside. I don't know, but the trend has been up. So until I see anything different, I'm kind of neutral to bullish. I do a lot of options and different types of strategies, like I said, income and neutral strategies, things like that. So I have all different things going on right now. So for the next week, I might be neutral, but over the longer term, I might be a little bit bullish. If we go up a couple weeks later and I think we're overvalued, I could be bearish for a couple weeks. So I can play it any way I want. But right now, until it breaks out and gives me, you know, a direction from these trend lines, I'm kind of neutral until it pops above or it pops below. This trend line at the bottom part here, you know, down here, pretty big. It's been in place for a long time, many, many months. And a trend line, the longer it's been in place and the more points it touches, the more valid it is. And we're getting right very close to it. So a disaster of an unemployment number on Friday, a disaster of earnings in a couple weeks for as Len said, for the quarterly earnings reports, maybe we go below it. So absolutely, if you're heavily invested in the equity markets, you need to be paying attention to this. Do you need to be lightening up? Do you need to be taking out some protection, hedging using options, hedging using foreign currencies? Because you now see a relationship. If the equity markets go down, possibly the United States dollar could go up. Because in the past, the equity markets have gone up and the United States dollar has gone down. So can you hedge using the equity, using the Forex markets on a longer term trade? Risk 200 or 300 pips to make 800, 900 pips. That's a long-term hedge using intermarket relationships if you have a larger account in Forex and you have a larger account over invested in equities and 401ks and IRAs and things like that. All right. So until we get above or below this, I'm kind of neutral, and then we'll see what happens paying attention to economic data. That is the equity markets. Let's leave the equity markets and move right into the Forex markets and finish up there. So a couple questions. How do you identify trade frequency through technicals? Again, I'm talking about my trade frequency, and I'm using volatility. I'm using the VIX. So if the VIX is low, I know that I'm going to be trading less frequently than if the volatility is high. As a day trader, I might trade once or twice a week with volatility at 13. If volatility is at 30 or 40, I might be trading once or twice or 3 times a day. So the volatility is telling me what's going on. Remember, you don't trade for 24 hours. If you're an intraday trader, and I'll show you this, you get to trade for the 3 or 4 or 5 or 6 hours you're trading. So I'm going to show you this. Before I do that, let me answer this. Len, don't cycles run about 3 years and you get reversals? Len, that's a pretty broad statement. I don't know what market you're talking about. My thing is, if you've paid attention to PIMCO and Bill Gross, when he talks, we listen. He's a big bond fund manager. He says it's the new normal. I call it the new economy. Everything's different. I've got to start from today and tomorrow and the next day and the next day and the next day. And I've got to manage my trades going forward. So I don't know if we can use past data so much because we're just in such a new environment with all this fiscal stimulus and things like that. Do you trade large positions to make scalping worthwhile? Yeah, that's the idea. I mean, I don't know what large means to you. I understand what I can handle as far as risk tolerance and account risk and things like that. For me, generally, 1 to 1.5% risk to 1 to 2% gain per trade of the portfolio, I think, is pretty achievable, and I can handle that myself. I don't think you need to go larger than that. Depends on your, how risky you want to be. But generally, traders risk 1 to 2% of their portfolio on any one trade, and that's the goal: is risk 1% to make 2% in a day trade of the portfolio scalping. That's kind of where I'm at. So Q4 preview technically, as far as the charts go, let me go ahead and bring those up for you. And then we just got a couple more slides to wrap up. So let's talk about trading right now. I am a intraday trader. Let's say I'm a scalper. All right. And I'm staying here right in the American region. All right. And the equity markets in the U.S. open up right here. So this is where the equity markets open up. So this is 9:30 Eastern. All right. Since 9:30, the euro against the US dollar has gone up 29.21 all the way up to 29.66. It's been in a 40 pip range since the equity markets opened up. So that is about 2.5, 3 hours. Okay. That's not a huge range, you guys, 40 pips. You had a little hiccup up, then it set back, and then it went up. So the trend overall has been up, and that's what it's continued to do. So that's what you have to focus in on, is what's going on in your trading time frame. If you trade during the 5 or 6 hours in the Asian session or the 5 or 6 hours in the European session, what is going on at that time? Here's what the pound is doing. All right, I'm going to bring this down to a 5-minute chart, and let's see. The stock market here in the U.S. opened up right here, and same thing. It's gone up and actually, it's kind of funny because today those intermarket relationships aren't working. The S&P is now down on the day, and the pound has gone up. Usually in the past, the S&P has gone down, the dollar has gone up. But here, the S&P is down, and the equity markets are going down, and the U.S. dollar is going down. So today is one of those days where you have to say these relationships aren't working. So the dollar is stronger or weaker against those two currencies. Here's the Aussie. Something must happen overnight here in the Aussie. That's way before, that's when I was sleeping. And so, because that's GMT time, I'm definitely not up. Now that's GMT time, 4:30, so I'm not in front of the markets then. So that might have set the tone for the Aussie because something came out and the Aussie has continued to weaken. So you have to pay attention to what's going on in your trading time frame, given the volatility, given economic data and fundamental data that's coming out. And that's how you base your trading. Take everything together, fundamentally, technically, in your trading psychology, and make a trading plan. But the bottom line is the volatility in the trading ranges is definitely smaller. We're used to 150 to 200 pip ranges in the pound versus US dollar. We're seeing 70 pip ranges now, you guys. So that's what I mean by how often do you get to try and make 15 or 20 pips if the entire day's range is 70 pips and you only look at it 5 or 6 hours of that 24-hour period, it might only be 40 pips like I showed you. So just because it's 70 pips in a day, I don't sit there for 24 hours and trade it. I only got 40 pip range to play with today in some of these pairs, okay? Because we do not sit and trade 24 hours. I don't think that you need to do that and work that hard. So going forward in foreign currencies, I expect trading ranges to continue to be small. I expect my trading frequency to be down. I expect to work very hard to develop a trading plan. And when that happens, I will manage it. And I'm not going to go for tons and tons and tons of pips. I'm going to go for a reasonable amount of pips. Until the equity markets do something different than what they're doing, I believe that this trend should continue where the dollar should continue to get weaker. If the equity markets start to change and really turn around and go down, that may change what's going on with the dollar. But it all depends. If the stock market goes down and the Federal Reserve says we're doing more easing and ECB doesn't and Bank of England doesn't, then the equity markets might go down. And like today, the dollar might get weaker against the pound, against the euro. It all depends. Tomorrow could be a brand new day as far as this whole fiscal stimulus. That's what you guys have to remember. Every day is a new day, all right? But as far as I'm concerned, right now, the dollar is the weakest one out there, and the equity market should continue to go higher until something really shifts that. Let me bring up the slides, and we'll wrap up. You probably your broker's favorite client. I guess it depends. If I'm telling people right now that it's not the time to trade, and I do a lot of education, you'll see on my site for other brokers, and they know that. They know that I shoot straight. They're okay with me doing it because they think that I'll help their clients become better traders. They don't want their traders blowing out and making poor decisions in bad markets. They want their traders staying around, being savvy, and when the markets get good, trading a lot. So I'm the first one to say, I don't go to a broker and say, I'm going to tell your clients to trade. I'm going to teach your clients to do, to read the markets as they are. How do you identify the odd high daily range candle where that happens about 1 to 2 times per week? How do you identify the odd high daily range candle that happens? Someone, a bank, a big fund manager, whatever, they might have an axe to grind and they might have to get things done. So that could be a price spike here and there. Right now, we're not seeing too many of those, but anything could cause that. If someone could have pressed the button wrong and entered the wrong amount of zeros, it could have been a real trade that had to go through. So, these spikes, in this, day and age of, high frequency and trading and stuff like that, you can never be, too sure. That's why we trade the right amount and we trade with plans. We do the best we can, but surprises can happen. The trading range is small because of the VIX. The trading range is not small because of the VIX. The VIX is low because the equity markets are high and there's no fear. The VIX is a fear gauge. If the world was falling apart, the stock market would be down, the VIX would be higher because there's fear and there'd be lots of trading opportunities. So the equity markets drive the volatility. Uncertainty drives volatility. Fear drives volatility. Uncertainty and fear and anxiety. Right now, the equity markets are saying there's no fear, there's no uncertainty, there's no anxiety. The VIX in turn is saying there's no fear, there's no uncertainty, there's no anxiety. The VIX doesn't go up first and then the stock market going down. The stock market goes down due to some event, terrorism event, a technical or fundamental event, and then the volatility will go up. If you want to believe that the equity markets are going to go down because they're overvalued and you want to profit from that, you either short the markets or you buy a call or go long the VIX. And if you're right and the stock market goes down, VIX will then go up as a effect of that. So that's what you're using the VIX for, to protect or hedge against your portfolio, or to tell you that trading ranges are small if you don't have a portfolio and you're just a short-term Forex trader. Okay. What do you think about the dollar reversed in September 14th? Someone just asked me, what do I think about the dollar reversing since September 14th? You've got to stay tuned. That is all my entire webinar next week, the one day, one topic on the 10th. So please stay tuned for that webinar. I'm going to talk about that in detail next week. Do you think the euro will survive? I was on a panel, the euro debt crisis a couple months ago. The euro is here. The euro is tradable. We're going to trade it. I don't know who's going to win the election. I don't know what's going to happen to the euro, but right now it's a trading entity and I'm going to trade it. And that's what you guys have to remember. Don't get caught up in this long-term vision of what's going to happen. Get caught up in making the right decisions right now and being a good trader and a successful trader. Going forward in the slides, your chance. JupiterPeakFinancial.com is my website. I can go ahead and type it in here so that you can get the link. I provide all kinds of data and commentary and webinars and things like that there. Again, no recommendations with brokers and things like that because I do education for other brokers. A lot of my education, or not all of it, a lot of my education there gets duplicated over to my profile at FXStreet. So that's another great place to go, is my FXStreet profile. But I do believe you're the system. I do believe that a lot of people approach the markets with unrealistic expectations, and some people don't even know how much the markets can actually do for them, given their big portfolio and their asset value and things like that in other places. So I provide a free, no obligation, unbiased opinion and summary called an engagement interview. It's kind of a low down, dirty look at pointed questions that I ask at you, and I give you my really, really straight opinion. I don't owe anything to you. I don't need to blow smoke for anyone. I tell you what's really achievable given my 15 years in the markets trading and my 4 or 5 years of consulting. So take advantage of that. You guys know how to get a hold of me via email. Moving forward, and I'll show you that in just a moment, those pages. To review, you learned about me and my consulting company. You learned that I think that your trading personality is important. You learned to combine fundamental analysis with technical analysis to make realistic trading plans using the VIX. We did our quarter 3 review looking at fundamentals and trends in the technicals, and quarter 4 preview that we may see slowing economic data, but we also may see more intervention and higher equity markets because that's been in the past. We'll have to see how bad things have to get to reverse the trend in the equity markets, to reverse the trend in the soft United States dollar. You learned a little bit about your opportunity with me that I provide some of my time for you. If a ski bum can do it, I was a ski bum. I wanted to just ski and work in a hotel and live in a resort town. And I met a trader and I learned to trade. If I can do it, you guys, I put this up for no matter who I'm teaching in front of, whether I'm teaching a class, live or doing webinars. I'm in person down at the local university. It does take time, discipline, focus, hard work, and a bit of experience, but allow yourself to gain the experience by trading correctly, given your trading personality, and you can be successful. Here's the resources, and I'll show you this in just a moment. You have my email at the bottom. You have my FXStreet profile. Stay tuned for next week's webinar on the high of the markets and high in the oil markets as well, and the low in the United States dollar in next week's webinar. My regular market commentary that gets duplicated over to the FXStreet profile is at Jupiter Peak Financial. About almost 3 dozen recordings there of webinars in the Forex markets that I provide for one of the bigger brokers out there, and one of the Forex brokers out there. And then obviously one-on-one engagement interviews. So lots and lots of great place to take advantage. And I'll show you this website in just a moment, and then we'll sign off. Someone asked about a question, do you have a definition of the Holy Grail? Absolutely, 100%. Take one guess what I'm going to say. The Holy Grail, you guys, take one guess. What do you think the Holy Grail is? The Holy Grail, all right, are you waiting for it? You can get a drum roll. The Holy Grail is going to be you, your trading personality, you as an individual. That is the Holy Grail. So really quickly, this is the website right here, Jupiter Peak Financial. Talks about the interview process, has links to economic calendar. Like I said, it gets duplicated over to FXStreet. But that's where you can find me and reach out to me and ask questions and get lots and lots of good commentary. And again, I'll leave you with this page, the FXStreet. Take advantage of their great analysis. Other collaborators like me, you've got to be reading, you've got to be paying attention. And this is a great place to do it. So thank you very much for your attention today. I appreciate it. And I have a feeling I'll be seeing a lot of you guys in the next week or so on the one day, one topic webinar that Maud had provided for you over there in the chat moderation panel. Thank you very much.